Let's get in Jeremy Zook, the Director of Sovereign Ratings from Fitch Ratings. Firstly, given the fact that the Q1 GDP numbers were slightly below estimates, does that change or pose a downside risk to Fitch Ratings estimates for India GDP?
We're forecasting 7.2% growth for this fiscal year. So mathematically, the 6.7% in the first quarter does pose a bit of downside risk to that forecast. But I think what's important to remember is that if we take a look under the hood, beyond that headline number, the underlying factors in the growth number were quite healthy, actually. So consumption growth picked up again. And investment was holding quite steady. So I think in our view, the fundamental structural factors that are driving India's quite strong growth remain. So, the downside risks are somewhat limited in that sense. And we still maintain a very strong view on India's economy over the next couple of years.
Perhaps because this is one of the fastest growing economies when you look at the economy of this size. But I also wanted to get a better sense from you regarding whether there are early signs of a private capex pick up or not, because a bulk of the heavy lifting for now has been done by public infrastructure spend. Are there any signs that Fitch Ratings is looking at that would point to a revival of the private capex as well?
Yeah, so certainly that's one of the big factors that we're thinking about when we look at the medium term. And we do see this as a potential risk to India's medium term growth outlook, which we estimate potential growth at around 6.2%. But, that is conditional on the private capex cycle picking up quite durably. I think, so far government capex has done, as you say, a lot of the heavy lifting. We've seen private capex in the real estate sector, though, certainly come in, and that's been quite healthy. What we're looking for, though, is more signs that manufacturing capex is picking up durably. I think we are seeing a few initial signs there. The consumption number should bode relatively well there if private firms have a little bit more clarity on a stronger consumption outlook over the medium term. They may be more willing to invest in some of these longer run projects. Capacity utilization is ticking upwards, so we also see that as a relatively positive near-term signal. But certainly I think that will be one of the key factors for our view on the medium-term growth outlook, which will also feed into our view on the sovereign rating.
Okay, and this is a question which I'm sure, Jeremy, you've been asked many times when it comes to India, and that's the fact, when do we get a ratings upgrade? Because the government, of course, has been doing a lot. The fiscal prudence that they have shown, at least even in this budget, the fact that the Indian RBI governor has been coveted as the best global banker with the way of management of inflation coming in, and the fact that they're looking at cutting down their expense, whether it's through sovereign bonds being, early redeemed or stuff like that. All of these are pointing towards the right moves coming in from the government and the RBI. What else is really needed to give us a bit of a fillip to reach towards a ratings upgrade then?
Yeah, so we just last week affirmed India's BBB- rating with a stable outlook. We have seen, of course, though, a lot of positive momentum in many of the credit metrics that we look at. First of all, the robust growth picture, India growing among the fastest of our sovereigns globally, the fastest major growing economy. So we've seen a lot of positive momentum, and that should continue to support India's fundamental, economic credit metrics that we look at. External finances are also very, very strong and stronger than BBB peers. When we look at public finances, certainly we note that there has been a tremendous amount of progress on the public finance front. The government has outperformed our expectations when it comes to fiscal consolidation. And we now think that the government will achieve its 4.5% of GDP deficit target for next fiscal year. We're forecasting 4.4%. So we've seen a lot of that progress occur. But when we look at India's public finance metrics more broadly compared to similarly rated peers, those all look relatively on the weaker side still. If we look at fiscal deficits, if we look at India's debt level, as well as the interest to revenue, the debt service burden, that is quite a bit above rating peers. The progress that we've seen on fiscal consolidation, that does increase the likelihood that the debt to GDP ratio will move on a downward trend over the medium term. I think what we're looking for is a bit more in the way of confidence around those forecasts. So a bit more clarity on the government's plans after fiscal year 26, where they have mentioned that they want to keep debt on a downward path, but a little more clarity on what will sort of be the guiding principles around that. And then, as I said, a bit more confidence in that very strong medium-term growth outlook coming from a private capex cycle. And both of those things would really cement our view of this downward trend in the debt to GDP ratio going forward.
Now, given the context of lower GDP growth and inflation, by when do you expect RBI to start cutting rates now?
Our expectation at the moment is for a rate cut, 25 basis points in the second half, well, in the next few months. Our view is that, yeah, inflation has been relatively contained. Food inflation, of course, has been a bit on the higher side and persistently so. But if we look at core inflation, that is hovering just above 3% and no real concerns on the core inflation front. But that being said, I think the balance of risks is towards later rate cuts. The RBI has been very focused on the persistence of that food inflation and concerns that that could spill over into inflation expectations. So while we do still expect a rate cut in the coming months, that could be pushed back, based on the RBI's relatively strong views on, the food inflation front.
Jeremy, on that note, we'll let you go. Thanks so much for joining us today with your take on India.
If you like this video, then like, share and subscribe to ET Now.